Good afternoon, ladies and gentlemen. We're going to get started. We're glad you could join us today for the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'll be guiding you through today's webinar, Understanding Put-Call Parity. I'm pleased to introduce our presenter today, Al Brinkman, who is a principal of Brinkman Group and a valued OIC instructor who has a breadth of options knowledge to share with us today.
Alex, thank you very much. And I'd like to take the opportunity to thank each and every one of you for taking some time out of your busy schedules to attend our webinar today on Put-Call Parity. And with that, let's get some things started here. There's the name of the thing. Just so we know who we are. The Options Industry Council is the industry resource funded through the OCC, and it's the education resource. And I think that really the important piece about the OIC is it's clear, unbiased information given to you to learn about utilization of options and risks and rewards, if you will, of utilizing listed options. The Clearing Corp, OCC, world's largest equity derivatives clearing organization, and really, when you step back and think about it, the next piece of that sentence, the foundation for secure markets in the country, the creation of and the efficiency of the clearing corporation is why listed options have become what they've become today in the investment world. And again, we have to have our usual disclaimer that options do involve risk and are not suitable for everyone. You will need to take an opportunity, if you haven't already, to get a hold of characteristics and risks of standardized options. It's available at optionseducation.org or through the broker that you're utilizing to execute options trades. It's a good document to take a look at. Any examples that we use today don't include commissions, fees, margin, and interest rates and taxes. So that's an important part of your calculation, but for educational purposes today, we're just not going to try to get involved in that. These are the U.S. listed options exchange as they stand today. There's been some consolidation in the industry over the last couple of years, and it's bound to happen. We had a lot of different exchanges, and they've come together on this, but there's 5 very strong exchanges trading options. I like this slide in particular because it does show that the options volume, how it's grown over the years since we first started. And I started back in 1975 in options and exited the business around 2010, somewhere around there, having gone through trading floor and then having gone through working for the Philadelphia Stock Exchange, now part of NASDAQ. Put-Call Parity. As you've gotten into your options education and as you move through your progress in learning options and how to utilize options in your investment strategies and where to use them and the risk rewards, you may have heard, or you probably did have heard in passing, this term, Put-Call Parity. We're going to try to bring a little clarity to that, what it is, why it's important to just have that knowledge of it, and what it does and what it leads to. As far as trading, why is this kind of part of this vocabulary? Why is this put-call parity? So really, easiest way to say it, the value of a call at any given price. I'm going to try to go back. The value of call implies a value of a put and vice versa. Standard piece of this, it has to have the same underlying, obviously the same strike price and the same expiration, and it's on any given day. And over on the right side of the slide, you can see that teeter-totter, and as one moves up and the other one moves down, it keeps a parity, if you will. Trading opportunities that come out of put-call parity or disparities, changes in put-call parity, are driven by an arbitrage, and we're going to talk a bit about that as we go into this. And it's not a pricing model driven trading opportunity that appears. So let's see if we can go through, and it's some basic ideas. What put-call parity really does is justify those prices that you see on the screen. Okay, and it applies both to the American and European style options. And it kind of explains how it works or how it stays in balance. All right, and as I mentioned, call price changes, put price is adjusted. And again, in its simplest form. So if the underlying stock price starts to move in one direction, the call price would move up. If the price is moving up, the put price would correspondingly move down. Again, staying within this put-call parity. In the broadest sense, the market maker is really the one person out there that's most concerned with this, is keeping the markets in line, because as I mentioned, if the markets get out of balance for put-call parity, if you will, for reasons we'll talk about, they may have that changes, that creates that arbitrage opportunity for trading in the market. So let's really quick, some points I want you to remember about put-call parity. It's not the options calculator. It's not Black-Scholes. It's not Cox-Rubinstein. It's none of those, okay? It doesn't provide you with a theoretical value because it doesn't have in its factor all the option pricing factors that we put in place. We push into the machine and it comes out with theoretical values. We even know that those, of course, can vary from what the theoretical says to what we see on the screen, and we'll talk more about that. Once they've been created, this put-call parity is the piece that keeps them in line through that, okay? Let's talk a little bit here about that theory. Put-call parity keeps it in line. The teeter totter looked pretty even. Said, all right, for this, for that, we get the relationship. One of the biggest parts of this, or the biggest, if you want to talk about the calculations, is called cost of carry. And simply put, cost of carry is what does it cost me to establish and hold position till it expires in the case of an option or is liquidated, let's say in case of a stock. That includes the cost of securities, how long am I holding the position, fees and commissions that may be involved. The purposes of put-call parity, these next two, interest paid or received, dividends paid or received. And of course, opportunity cost is kind of like the overall thing. If I did this, put the money into this, if I had done this, did I give up opportunity cost, that type of thing. I think the old story there was if I had $100, invested $100 today, and I still had $100 a year later, did I make or lose money? I lost money because opportunity cost. Be that as it may. For the case of cost of carry, the interest and dividend involved in the underlying stock is why the put and the call are not priced exactly the same. Because if that wasn't included in the equation or didn't have any factor in there, the interest rate or potentially a dividend, yes, they would be exactly the same. The put would be one and the call would be one, but usually there's that difference, and that's because of the interest rates. I mentioned at the start, arbitrage. Arbitrage is out of balance. Something gets out of balance. Opportunity to profit from a price difference, in the broad sense, identical or similar instruments in different marketplaces. In the option market, that would be difference in put-call prices. It's not out of line. It's out of line with parity. And then the stock market, there may be a lower offer or a different offer down the road in the stock. In the case of arbitrage, it's very important to note that disparities, if you will, in pricing that occur not frequently. They also do not occur quick for a long time, because the markets today, the market has always had very good efficiency to it, but particularly today with the advent of electronic trading and logarithms and algorithms and people are trading quickly, price disparities are quickly taken advantage of. And once again, this is where that market maker plays into this, where the professional trader, the market maker, has the ability to see this and react to it. For you and I, to be perfectly honest with you, we're not going to be looking for this type of trade that we're going to talk about, the arbitrage trade, in a minute, just to give it to you, give you some background on it, to take place. But there's some more about put-call parity that down the road that has some importance in our strategy. So the question that may come up, does put-call parity always apply and will always hold true? It does hold true, but circumstances can throw that out of balance before the fact. Just like you can get some things changed on theoretical values because you have them, why are they different than on the screen? Same kind of ideas. The basic one would be supply and demand. Temporarily imbalances in supply and demand, more buyers than sellers, more sellers than buyers. They could be for a variety of circumstances. Pending news reports, special dividend payments, anticipating changes in the underlying with regard to their dividend payments. Interest rates change. Remember, put-call parity, the calculation involves interest rate, that cost of carry. So these things can push it for a temporary imbalance from put and call parity. That opens up that arbitrage trade opportunity that's out there. All right. If you make a arbitrage transaction, you can lock in a profit. You can take advantage of it, and that's the advantage of making this trade. Now, some assumptions that a market maker would have to have in here that it assumes no change in the carrying cost, the interest rate will remain constant, and the dividend unchanged for the length of time that you've put this particular trade on. There are big pieces to this, and keep in mind, once again, the differences, the opportunities are small. Okay? The opportunities are small. So you have to do these in reasonable quantity to lock in the profit. That again points it to the market maker. The two types of trades are called conversions and reversals. We're going to talk a little bit more about those. And keep in mind, before the Black-Scholes, pricing was not a very exact science, and it still kind of isn't to a degree from that. But put-call parity was the one thing that kept in value. Before we move on, I know another question that may come up that I'd just like to touch on quickly was implied volatility. We talked about, the option pricing formula here and put-call parity. Well, what about implied volatility? That's a big piece of our pricing, clearly, on the theoretical value, giving us our theoretical values, which then put-call parity keeps in line. Remember, once again, changes in implied volatility affect puts and calls to the same degree. Higher volatility, higher call, higher put prices. So implied volatility affects the underlying price of the option. Put-call parity keeps it in line. As a retail trader, we focused on that implied volatility number related to the options premium that we see on the screen. Where our relationship comes in with implied volatility across the board, of course, is where is it in relation to where it's been? Is it higher? Is it lower? That type of thing. Where does it put the premium? Is it higher or lower than it's been? Looking back a little bit, where is it in the level? And then that, of course, impacts the trading decision that we make. High-priced option, low-priced option, what do we see on the distance? As I mentioned, the basic formula for put-call, call minus put equals the stock price minus the strike price, and there's the interest in dividends. Same options, same strike and expiration. The interest rates remain constant. Underlying dividend policy doesn't change, and of course, there's no exchange fees, which again helps with the market paper type thing. The strategies that maintain proper put and call parity are conversion and reversals. And by that I mean, if the put-call parity equation gets out of line, market makers primarily will execute conversions or reversals. They will bring it back in line. Doesn't last long. Very quickly, we'll just take a look at conversions and reversals. The conversion, long put, short call, combined with a long stock position. Just by me saying that, I think you can see that that's a relatively complicated position to put on, and it virtually gets put on simultaneously to lock in the arbitrage or the risk-free profit. And don't let the thought of it being considered fundamentally a risk-free profit position lure you into spending hours in front of your screen trying to look for these. As I said, in today's world of electronic trading and such, they don't come along very long, and they also are taken advantage of quickly when they do. And the other trade on this is the reverse conversion, or reversal as it was called. Long call, short put, short stock position. Short stock position, difficult position to put on just by itself. So once again, these are the kind of today are really the place for the market maker. Back when I started in the business years ago, market spreads, bid-offer spreads were much wider than they were. Liquidity was at a different type of level, way different kind of level. And this type of transaction conversions, reversals were very common at that point in time because you could set that up. You had the opportunity to get it on. It didn't take place very quickly. And we used to get constant orders on the trading floor to do this conversion or that reversal, that type of thing. And in fact, some firms, to take advantage of that, even set up specific desks or individuals on a desk that was their job to look for this type of trade. No more today. It's governed by electronic. Let's talk about synthetic options, because now this is where you and I, as the retail, where the put-call parity kind of allows us to create a synthetic position utilizing options and stock together to create something. So if I were to say what's a definition, what do I mean by a synthetic? We're going to combine different substances. In this case, puts, calls, and stocks are our substances. We're going to come up something that looks and acts very much materially like something else. It creates a synthetic of something, if you will. I want some fundamental thoughts. Just let's break this down before we get into these, before we go here real quick. Once you create a synthetic position, they're not necessarily an equivalent position to what they've created, the substance you've created. The option pricing factors, delta, theta, implied volatility, all play a role. So subtle differences in these strategies. They're close and have almost identical P&L risk-reward profiles. They are, however, alternative strategies. That's how I need you to think about the synthetic position. We'll talk about a couple of those when we look at synthetics in just a moment. But you want to think about it as, I could do this, or I might be able to do this. I might be able to create this position synthetically. What would be my risk reward? Why would I take a look at it? And keep in mind, you need to keep in all your pricing factors and all your other factors. Starting out with synthetics, here's our stuff we're going to combine. You're either long stock or you're short stock. You're either a long a call or short a call. You're long a put or short a put. That's it. That's what you've got. We're going to combine those with more complex, the synthetic versions. It's going to be a combination of stock and options, or just options. As always, strike prices and expiration months need to be the same. And, we've kind of covered this. Prices of stock, puts and pulls are interrelated. That's the put-call parity piece in there that we come along. They are interrelated. That allows us to create this synthetic version. So there's a couple more on the presentation that I'm going to be able to go over, but we'll go over a few of these just to get the basic idea down. Take some time to study these and take a look at them, considering them as an alternative strategy to add to your portfolio. And as I say, at any time, you need to, here's my forecast for the underlying, what are the strategies that I have available, and what are the good and the bad and the ugly about utilizing these strategies. The first one I want to talk about is we're going to create a long stock position synthetically using options. So we're going to have a short put and a long call. And it's easy to see from the diagram that it has the same P&L as the stock would. But what's the difference? What are we looking at here? Well, a couple things. The question is, shall we buy the stock outright or sell a put? Well, it depends on our thoughts on the underlying of what we'd like to go here, because we could also just do a long call. That gives us a stock position, but basically with the option. But now we've got a short put. A couple things have happened here. One, we've short the put and long the call. We've reduced our cost significantly from it because we've sold and we bought. So we reduced the overall cost. It's certainly a lot cheaper than if we had done just the stock by itself, and also than the long call in the overall picture. But what's our trade-off? There's always a trade-off with the option. In this case, it's time. It's how much time we have and what's our underlying thoughts on the stock. We've kind of hedged our position because, we could be in a position to get the stock or short at a lower price if it continues, or we have the opportunity to get long the stock as it continues up with the long call. So we've got a little bit of different situation here. Buying the stock alone, finance the position, that's the opportunity cost in there. We may get a dividend, which reduces the cost, but our risk is all to the downside in this. As I said, the option position is going to be a less costly, but it has a limited life. We can also create a synthetic short stock position. In this case, we're long a put and we short a call. Think about the bigger picture of short stock. When you have a situation where borrowed interest rates are paid, it's a very difficult thing to get off just with the stock. We could also just go long a put. Going back to what's our forecast? Everything always comes down to the forecast from the underlying in my mind. But in this case, once again, we've reduced our cost, overall cost. We have the same time constraint. So we can look at it from that point of view. But we have to be cognizant, and I think you need to be cognizant all the time. My soapbox in options trading is whenever you do a position that involves an option, whether it's just plain long call, short, long put, understand what right or obligation you've undertaken. Am I okay with this right? Do I understand the obligation I have on this position? So we can do a synthetic long put. We can create a long put position. Once again, we're reducing the cost as your primary here. And while we have just a few minutes left, I want to go to one here. Take a look at this one in particular. I'm sorry it took so long to get there. The synthetic short put. Take a look at the baseline position. Look familiar? We're long stock and we're short a call. I could take this and we put the name up there. Instead of calling it a synthetic short put, we could call it a covered call. Long stock and we're short a call. So you could say to everybody instead that I do covered calls, I do synthetic short puts. Is what you can tell people. Again, time's running out. Take a look at some of these, spend a few minutes with them. They are alternative strategies. They're good to know they're there because of the cost factors involved with these, but they have to be weighed against all the other factors involved in just the plain old option strategy or just the plain old stock in the portfolio. Long stock, getting long stock, or trying to get short the underlying stock. And remember the risks and the trade-offs for utilizing options, and always, always, always your rights and obligations. Summary real quick, this is where put-call parity brings things into light. Put-call parity allows us to create these synthetic positions. What does put-call parity really mean for this? It proves the efficiency in options pricing. And it allows the equivalent strategies, covered call, cash secure put writing, to be created. So it's something to have in the knowledge in your arsenal to understand. When you hear the term, you say, yes, I understand. That's how I can do synthetics, and it keeps prices and makes them efficient. So with that, Alex, I will turn this back to you as we're right about on time.
Thank you, Al, and thank you, ladies and gentlemen. Many of you asked about further education. Please visit optionseducation.org, and you can access additional resources and see the Getting Started section for further reading. You can also access OIC's MyPath assessment to gauge your options knowledge and receive a custom learning program to advance your investing skills. And of course, make sure to check out the website for upcoming events. Our next webinar will be held May 24th at the same time, 1 p.m. Central Time. You can quickly register by clicking the URL link icon at the bottom of your console to register. And again, thank you for attending, and we hope to see you next time.